Hello, and welcome. If your company is investing in innovation, software development, or engineering improvements, you're likely familiar with the Research and Development Tax Credit under Internal Revenue Code Section 41. But identifying your qualified research expenses, or QRS, is only half the battle. The real statutory strategy lies in how you calculate the credit. Section 41 provides two primary methodologies for general business R&D: the regular research credit method and the alternative simplified credit method. Choosing the wrong one doesn't just mean leaving money on the table. It can expose your company to immense record-keeping burdens and IRS audit friction. Today, we're going to break down how both methods work, the mathematics behind them, and how to strategically elect the right path for your business. Let's begin with the regular research credit method, often referred to as the RRC. The regular method is highly rewarding, offering a statutory credit rate of 20%. However, it is fundamentally an incremental credit, meaning it rewards you for outperforming a historical baseline. The formula multiplies 20% against the amount by which your current year QREs exceed a statutory base amount. Calculating that base amount is where the complexity begins. It requires multiplying your average annual gross receipts from the prior 4 years by a fixed base percentage. For older companies, that percentage is tied to an identical ratio from the mid-1980s. For newer startups, the IRS dictates a complex rolling phase-in schedule. There is a crucial statutory guardrail here. By law, your base amount can never be less than 50% of your current year expenses. This is known as the minimum base amount floor. While the 20% rate is incredibly powerful for businesses with low historical baselines, the administrative burden of proving decades-old data can be a massive headache under audit. Recognizing that tracking 1980s data was becoming a logistical nightmare, Congress introduced the Alternative Simplified Credit, or ASC. As the name implies, the ASC strips away historical gross receipts completely. Instead, it focuses exclusively on a rolling 3-year look-back window of your actual R&D spending. The math works like this. You determine your average QREs over the 3 prior tax years, cut that number in half, and subtract it from your current year's expenses. You then multiply that result by 14%. If you happen to have no R&D spend in any of those 3 prior look-back years, you get a flat 6% credit. The trade-off here is obvious. You are accepting a lower statutory rate, 14% instead of 20%, in exchange for an incredibly clean, predictable data tracking process. Every year, when we sit down to prepare IRS Form 6765, we model both methods. The choice is rarely a simple mathematical comparison. If your company has undergone recent mergers, acquisitions, or significant changes in gross receipts, the regular method might completely choke out your credit. Conversely, if you are a lean startup with explosive R&D growth and low revenue, the regular method could yield twice the cash benefit. But beware of the procedural rules. The election to use the alternative simplified credit must be made on a timely filed original tax return and is legally binding for that year. Navigating Section 41 requires balancing the immediate cash flow of the credit against the long-term cost of compliance and audit defense. Before filing, ensure your tax team has rigorously modeled both paths. Thank you for watching. If you have questions, please reach out to our team. We're here to help.